This year's U.S. election saw a powerful red wave with Trump and the Republican Party winning not only the presidency but also majorities in both the Senate and the House. Republicans even led in governorship across the states, making it a decisive victory. Harris couldn't secure the popular vote, underscoring just how little public support she received. With Trump back in the White House, Xi Jinping is likely the one losing the most sleep, as Trump's victory suggests a renewed U.S. China trade war. Xi clearly wasn't hoping for this outcome, and it's easy to see why. China's fiscal authorities have indicated that a Trump win would mean issuing even more national debt, with 10 trillion yuan barely enough. A U.S. president who could pressure China into flooding its economy with stimulus isn't exactly Xi's ideal choice. No one wants to strain their own finances. Hello, I'm Dong Xiong, and welcome to Dig Into China, where we dive in deep into China to uncover insights you won't find elsewhere. In today's video, I'll discuss the three major challenges Xi Jinping could face in Trump's second term. The next 4 years could very well mark the unfolding of many significant historical events. With Trump back in office, the first challenge Xi Jinping faces is tariffs. I've covered the effects of U.S. tariffs on China in previous episodes, but following the election, the renminbi, along with nearly all currencies, depreciated sharply against the dollar. This reflects Trump's global tariff policy and, more broadly, the strong appeal of the U.S. market. If countries want to retain access to the U.S. market, they will need to absorb the cost of these tariffs. Trump's drive to bring manufacturing back to the U.S. inevitably means a stronger dollar, as he aims to attract more investment into the American economy. For China, there are only three possible strategies to respond to Trump's high tariffs. The first option is for China to negotiate with Trump, offering other concessions in exchange for tariffs reduction, such as promising to buy more U.S. soybeans. However, during the first trade war, China failed to fulfill its commitment to purchase the agreed amount of soybeans, which forced the Trump administration to spend over $10 billion subsidizing American farmers. Because of this, Trump is unlikely to fall for the same tactic again, and China won't be able to cheat its way out. Moreover, while the previous tariffs on China peaked at 25%, this time they could go as high as 60%. So just how much soybeans would China need to buy to offset such a massive tariff? Additionally, when China buys soybeans with US dollars, it depletes its dollar reserves. With the currency depreciation, rising import costs also drain dollars. So which of these options is more cost-effective? The Communist Party will likely consider both carefully. However, I believe the first option is more beneficial. Why? Because it signals a gesture of humility from Xi Jinping, showing his willingness to compromise and appease Trump. It's like saying, hey, you are in charge, I'll follow your lead. This kind of message matters to Trump, as he's known for holding grudges. If you oppose him, he'll retaliate in any way he can. I believe that once Trump returns to the White House, the US and China will quickly enter negotiations. China will likely agree to a range of new import deals, but I think Trump will still press forward with additional tariffs on China. Even if Beijing accepts certain terms, it will probably only reduce some of the tariff burden. For instance, if the tariff was set to rise by 100%, it might be lowered to 60%, but that 60% tariff would still be quite damaging. Thus, Xi Jinping will need a second strategy: relocating industries. However, this option comes with considerable risk. Why? Because the Trump administration has already indicated that it will increase tariffs on countries like Vietnam and Mexico, which are used for re-exporting goods to China. To plug the tariff loophole, as a result, China will likely have to abandon relocating industries to these countries. So what would be the best destination for relocating industries? It would likely be countries with the closest ties to the US, such as Japan. As a key US ally, Japan is expected to face the fewest tariff hikes under Trump. While Japan's manufacturing costs are higher than China's, when tariffs are factored in, the total cost might still be lower than producing in China. Naturally, the industries relocating to Japan would need to be high value-added ones. For example, if Xi Jinping decides to bet on China's new generation production capabilities and sets up factories in Japan, it would likely be more cost-effective than establishing them in the U.S., while also circumventing high tariffs. Lastly, Xi Jinping has one more option to respond to the new trade war, dumping goods in other countries and giving up the U.S. market. However, this is a risky all-or-nothing approach. Without access to the U.S. market, China would need to find a new market for its products. The only way to do that would be through aggressive price cuts, flooding developed markets like Japan, South Korea, and the EU with cheap goods, driving out competitors and claiming their market share. But this could trigger high tariffs from those markets as well, as they would seek to protect their own industries. No country would let this go unchecked, making this strategy a highly risky move. After considering these three possible responses, it seems the best course of action would be for Xi Jinping to bow to Trump and secure the most favorable terms in negotiations. This might even involve offering non-economic concessions in exchange for tariff relief, such as Xi Jinping promising that the Communist Party won't take military action against Taiwan for a century, or signing a new peace agreement across the Taiwan Strait. Of course, this is just my speculation. Xi Jinping may not be willing to make such significant concessions, as in his view, the Taiwan issue could be more important than economic concerns. Having covered the tariff issue, let's now turn to the second challenge Xi Jinping will face: boosting domestic demand. The logic is straightforward. Xi Jinping is likely to face a major setback in foreign markets. Not only will China be hit with higher tariffs from the US, but other developed countries, fearing China's dumping practice, may also impose their own tariffs. This will severely impact China's export businesses. With foreign demand shrinking, the only alternative is to rely on domestic demand to fill the gap. We've discussed how to boost domestic demand multiple times, and there is only one solution: increasing people's incomes through redistribution reforms. So Xi Jinping faces a critical decision: either implement these reforms and anger powerful interest groups, or watch China's manufacturing sector collapse, with export businesses going under. As we discussed earlier, Xi Jinping could relocate factories to countries like Japan, which are U.S. allies, to avoid high tariffs. However, it's important to remember that while moving manufacturing abroad might help China continue to earn foreign exchange, the immediate impact within China would be widespread job losses, further weakening domestic demand. No country would allow this manufacturing base to be fully outsourced, especially since in the event of a war, overseas business cannot be counted on, and essential goods must be produced domestically. So, how can China move all its manufacturing out? Ultimately, Xi Jinping has no choice but to focus on boosting domestic demand. Either he raises wages and provides welfare for the people, or he faces the collapse of the manufacturing sector. So, what is the third challenge Xi Jinping will face? It's debt. On November 7th, following the conclusion of the National People's Congress Standing Committee meeting and the announcement of the fiscal debt issuance plan, people were taken aback. It was much smaller than expected. This wasn't just my personal opinion. Just observe the market's response. As soon as the fiscal plan was released, the A50 index fell sharply, and the yuan weakened, signaling that the debt issuance fell far short of market expectations. This time, the government announced three figures: 6 trillion, 4 trillion, and 2 trillion. What do these numbers represent? Let's go through them one by one. The first figure, 6 trillion, represents the additional quota for local government debt. From 2024 to 2026, local governments will be permitted to issue an extra 2 trillion annually, aimed at replacing hidden debts. The second amount, 4 trillion, pertains to the special bond quota for local governments over the next 5 years. Each year, local governments will have 800 billion available to replace hidden debts. This 4 trillion doesn't raise the overall debt limit for local governments. It simply makes use of existing special bond quotas. The main difference is that with these 4 trillion in special bonds, local governments no longer have to search for projects to get central approval. They can directly issue bonds under the purpose of replacing hidden local debts, which essentially broadens the allowed use of these funds. Why is this happening? Because local governments are struggling to come up with viable projects to issue bonds. Previously, they were the fabricated projects to deceive the central government, issuing bonds under the guise of these fake projects, while the funds were actually diverted to cover other debts. Now the central government has seen through this and has decided to take a more direct approach. Instead of allowing local governments to deceive them, they've allocated an annual 800 billion specifically for debt repayment, essentially letting local governments use new debt to service old debt. The final 2 trillion is designated for hidden debts related to shanty town redevelopment, due to mature after 2029. This debt will continue to be repaid according to the original agreement, meaning it won't be replaced with local government special bonds for now. Essentially, there is no increase in the bonds issuance capacity for local governments. To sum up, the National People's Congress has only approved an additional 6 trillion in local government bonds, spread over 3 years, equating to a yearly increase of 2 trillion. The other amounts mentioned pertain to existing debt with adjustments in their usage, but do not impact overall bond issuance limit. All the bond issuance plans from the government are aimed at debt reduction, helping local governments ease their financial burden, but none of the funds are allocated for development. There's no money for social welfare, and even the real estate sector is left to fend for themselves. Why is that? It seems like the Communist Party is signaling that they won't be stimulating the economy this year. No consumer incentives, no investment, and no support for the real estate industry. Beijing has simply chosen to lie down flat. Let's revisit the 10 trillion yuan fiscal plan that was previously reported by Reuters. It was stated that Beijing planned to issue 6 trillion yuan in bonds over the next 3 years to help local governments replace hidden debts, along with another 4 trillion yuan to allow local governments to purchase unused land and property, totaling 10 trillion yuan. If Trump were to be re-elected, even larger amounts would be considered. This information was released by Beijing before Trump's election. So why did the bond issuance scale decrease after his victory? I believe Xi Jinping might have found a more effective way to navigate the trade war with Trump without resorting to massive economic stimulus. This new strategy likely involves Elon Musk. Musk's backing helped Trump win, and he has clearly become one of Trump's key advisors. So his influence is significant. Given China's positive relationship with Musk, it's possible that Xi sees him as a potential intermediary to open talks with Trump and explore whether there is room for negotiation in the trade conflict. It's even possible that China has already reached out to Musk and received encouraging responses. As a result, Xi may have decided to hold off on economic stimulus measures, hoping that improving relations with Trump through this route could be a more effective approach. However, I believe this possibility is slim. Firstly, Trump's foreign policy is focused on prioritizing efforts to counter China. His desire to end the Russia-Ukraine conflict is largely about stabilizing Russia to shift the focus towards China, as Vance himself has stated. Given this, it seems highly unlikely that China could alter the entire dynamic of Sino-U.S. relations with just Musk's help. That would be unrealistic. Elon Musk's influence simply isn't strong enough to change the broader geopolitical trajectory. Secondly, Musk's relationship with China isn't as close as it might appear. It's more about mutual benefit. Musk faced heavy pressure from the U.S. Democrats, and his stock was often targeted by the short sellers on Wall Street. So he turned to the Chinese market for support. In return, China benefited from Musk's gigafactories, the supply chain Tesla brought, and Musk himself served as a symbol of the still existing ties between the U.S. and China. Essentially, both sides have been using each other for their respective goals. However, Musk's reliance on China has significantly decreased as his situation in the U.S. has stabilized. Additionally, Musk does not share the same ideological alignment with China's authoritarian regime. He is now firmly positioned within the America First camp and is unlikely to prioritize China's interests over those of the U.S. So, my conclusion is that China is holding off on significant fiscal moves and not increasing government debt because it wants to wait until the full impact of Trump's tariff policies is clear. Since the tariff measures are not expected to take effect this year, and the U.S. importers may stockpile goods in preparation for the trade war, China's exports could actually see a temporary boost. This gives China confidence that it can meet its GDP targets for the year, leaving fiscal measures for next year to support economic growth. These are merely my personal opinions and assessment, and only time will tell if they are accurate. Fortunately, we won't have to wait too long to find out. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.